Your bank understands compound interest perfectly. It applies it to your mortgage, your credit card, your car loan, your overdraft, every single product it sells you. It is the engine behind every dollar your bank makes from you. And here is what is interesting. That exact same engine, compound interest, is available to you to use in your favor through the same financial system. The bank is not hiding the concept, it is just not explaining it. Because there's a significant difference between a customer who understands compound interest and one who does not, and banks have always preferred the latter. This video is going to do three things. First, explain compound interest from the ground up, clearly and completely, so that you never have to guess at it again. Second, show you exactly how banks use it against you with real numbers. Third, show you how to use the exact same force in your own favor. By the end of this video, you will look at every financial product, every loan, every account, every offer through a completely different lens. Let's start from the beginning. Let's start with the definition, the real one, not the textbook version. Compound interest is interest earned on interest, not just on your original amount, but on everything that is already accumulated. Here's the difference. Simple interest. You invest $1,000 at 10% per year. Every year, you earn exactly $100. Same amount, forever. Your principal never changes. Your interest never grows. It is flat. Compound interest. You invest $1,000 at 10% per year. Year 1, you earn $100, but that 100 stays in. Year 2, your balance is $1,100, so you earn 10% of $1,100. That's $110. Year 3, your balance is $1,210. 10% of that is $121. The interest amount grows every single year because the base it is calculated on grows every year. That's compounding. Here's the formula. A equals P times the quantity 1 plus R raised to the power of N. A is your final amount, P is your principal, the money you start with, R is your interest rate as a decimal, N is the number of periods, usually years. Let's use it. $1,000, 10% per year, 10 years. A equals 1,000 times 1.10 to the power of 10. That's 1,000 times 2.59. That equals $2,593. You put in 1,000, you got back 2,593. The extra $1,593 was not earned by you. It was earned by your money, reinvesting itself year after year. Think of it like a snowball rolling downhill. At the top, it's tiny. It picks up a little snow. Then that snow helps it pick up more snow, then more. The bigger it gets, the faster it grows, because more surface area touches the ground. Your money works exactly the same way. A small amount, given enough time, becomes unstoppable. Not because you added more, because you let the process run. Time is the hill. Compound interest is gravity. And the longer the hill, the faster and bigger the snowball becomes. Now, let's talk about the side of this equation your bank never highlights. Every loan a bank gives you, mortgage, credit card, personal loan, car finance, uses compound interest, but the rate is set in the bank's favor, and the structure is designed so that you pay the maximum amount of interest before you pay down any principal. Take a credit card at 20% annual interest. The bank does not tell you this debt doubles every 3.6 years. It tells you your minimum payment, and that minimum payment is carefully calculated to keep you in debt for as long as legally possible, while the compound interest works quietly in the background, growing your balance whether you notice it or not. Let's run the real numbers on a credit card debt. You carry a $5,000 balance at 20% annual interest. You pay the minimum each month, let's say around $100. How long does it take to pay off? 22 years. And how much do you pay in total? approximately $12,300. You borrowed $5,000. You paid back $12,300. $7,300 went directly to the bank as interest. The bank lent you $5,000 and received $12,300 back. That's a 146% return on their money. And they did nothing. They just understood compound interest and structured the product accordingly. Now, let's look at a mortgage, a $300,000 home loan at 6% over 30 years. Monthly payment, approximately $1,798. Over 30 years, your total payments, $647,500. You borrowed $300,000. You paid back $647,500. $347,000, more than the value of the house itself, went to the bank as interest. You paid for the house twice and handed the second payment entirely to the bank. Again, this is not illegal. This is not immoral. This is compound interest applied over a long period of time at a rate the bank sets. And the bank sets it because it understands the math. The question is whether you do. So, why don't banks just explain compound interest clearly to every customer? This is not a conspiracy. It's not a secret society. It's something simpler and more uncomfortable. A customer who fully understands compound interest behaves differently. They pay off debt faster, they challenge interest rates, they choose products more carefully, they ask questions. A customer who does not understand it accepts the minimum payment, rolls over the balance, pays the fee, and comes back next year for the same product. That customer is significantly more profitable. Banks are not evil, they're businesses, and their business model depends on customers not fully understanding the cost of borrowing over time. The information is available, the explanation is just not in their interest to give.
There is also the savings side of this equation, and it is equally telling. When you deposit money into a bank savings account, the bank pays you interest. The current average savings account rate in the U.S. is around 0.5% per year. The bank then takes your deposited money and lends it out to other customers at 6, 15, or 20%. The spread between what they pay you and what they charge borrowers, that is their profit, and it is substantial. At 0.5%, your savings double every 144 years. At 3% inflation, your purchasing power halves every 24 years. You are not saving, you are losing ground, slowly, every day, while the bank uses your money at 20 times your rate. Here is where this video changes direction. Everything we have shown you about how compound interest works against you, the same mechanism, the same mathematics, the same formula, can be flipped entirely in your favor. The bank charges you 20% compound interest on your credit card. You can earn 10% compound interest in an S&P 500 index fund. The rate is different, the direction is opposite, but the mechanism is identical. The difference between the bank getting rich off compound interest and you getting rich from it is not intelligence, it is not income, it is not luck. It is which side of the equation you are on, and you can choose your side. Step 1. Eliminate high-interest debt first. Any debt above 8 to 10% is compounding against you faster than almost any investment can compound for you. Paying off a 20% credit card is the equivalent of earning a guaranteed 20% return. No investment in the market offers that guarantee. Step 2. Start investing the moment high-interest debt is gone. Not next month, the day the debt is cleared, because every day of delay has a real compound cost. Step 3. Use low-cost index funds that return approximately 10% per year over the long term, the S&P 500, not individual stocks, not active funds with high fees, the simple, boring, proven option that lets compound interest do the work. Let's show what happens when you flip the direction. You are 30 years old. You have no high-interest debt.
You start investing $200 a month in an S&P 500 index fund at 10% annual return. At 40, 10 years in, your account holds approximately $41,000. At 50, 20 years in, $152,000. At 60, 30 years in, $452,000. At 65, 35 years in, approximately $760,000. $760,000 from $200 a month that you started at 30 after eliminating your debt. The bank used compound interest to build its wealth. You just used the same tool to build yours. Now that you understand compound interest, let's walk through every major banking product and decode exactly what is happening under the surface. The mortgage. The bank lends you $300,000 at 6% over 30 years. Over those 30 years, you pay $647,000. The compound interest earned by the bank from a single mortgage customer, $347,000 per customer. The credit card. The bank issues a card at 20%. Every unpaid balance compounds monthly. The average American credit card holder pays over $1,000 a year in interest alone, per card. The bank issues millions of cards. The savings account. The bank pays you 0.5%. It lends your money at 6 to 20%. The spread is its income. Your deposit is its raw material. So what do you do with this information? 4 things. 1. Read the APR on every financial product before you sign. APR stands for annual percentage rate. It is the compound interest rate. It tells you exactly how much the product costs you per year. Compare it to the rule of 72. If APR is 20, your debt doubles in 3.6 years. Always apply the rule of 72 before you sign. 2. Negotiate or shop interest rates. Banks compete. A 1% difference on a 30-year mortgage is tens of thousands of dollars. That 1% is worth 2 hours of your time to find. 3. Pay more than the minimum. The minimum payment is the most expensive way to use a credit card. Every extra dollar paid reduces the compounding base. The effect is exponential in your favor. 4. Use compound interest as a builder, not just a cost. Every product that pays you compound interest, index funds, dividend reinvestment accounts, bonds, puts the engine on your side. Here is the uncomfortable truth about why compound interest is not taught in most schools. It's not a conspiracy. Schools don't teach it because the financial system hasn't prioritized it in curriculums. And the financial system hasn't prioritized it because a financially literate population asks harder questions, demands better products, and generates less fee income. That's not sinister, it's structural. The incentive to teach compound interest to everyone doesn't exist within the institution that profits from it not being taught. So the responsibility falls to the individual. And the good news is that compound interest is not complicated. It is one formula. It works in every direction. It takes about 30 minutes to understand completely. This video is that 30 minutes. Albert Einstein, whether he actually said it or not, is credited with calling compound interest the 8th wonder of the world. And the full quote continues, "He who understands it earns it. He who doesn't pays it." That quote has been repeated so many times it has lost its weight. So let's restore the weight. You have been paying it through your credit card, through your mortgage, through your savings account that barely keeps up with a toaster's resale value. Every product the bank has sold you has been on the paying side of compound interest. This video is the line. Before it, you paid. After it, you earn. The formula has not changed. The direction has. 5 things to take from this video. 1. Compound interest is not complicated. It is interest on interest. A equals P times 1 plus R to the power of N. That's the whole formula. It works on everything. 2. Banks use it against you on every product they sell you, not maliciously, structurally. The minimum payment, the savings rate, the loan term, all designed with compound interest working in their favor. 3. The same mechanism works in your favor when you invest. An S&P 500 index fund at 10% compound annual return is the same engine pointed at your jar instead of the bank's. 4. Eliminate high-interest debt before investing. The math is unambiguous. You cannot out-invest 20% compound debt. 5. Financial literacy is not optional. The gap between understanding compound interest and not understanding it is not academic. It's 6 figures, at minimum. The bank is not your enemy. It's a business, and like any business, it works in its own interest. The way to work in your own interest is to understand the tools the business uses and use them yourself. Compound interest is not a secret. It is a formula, and you now know it completely. What you do with that knowledge is the only question left. Compound interest is the most powerful force in personal finance. Banks have understood this for centuries. You now understand it too. If this video gave you a genuinely different way to look at every loan, every savings account, and every investment you will ever encounter, hit that like button and subscribe. We break down one financial concept in every video in a way that's clear, real, and built on actual numbers. And share this with one person who is still on the paying side of compound interest, because the cost of not knowing this is not theoretical. It is real money every month. See you in the next one.